Hello and welcome to ET Interview. The debate which in a sense everybody is trying to dissect and discuss and ideate is that what will be the impact of the second wave? In the first wave the fear was more, but the number of affected people were less. In the first wave there was a national lockdown, but in the second wave we only had regional lockdowns. So will the impact both in terms of number of cases and casualty have a greater economic impact, or this time around the relative impact would be less? Why are markets ignoring the obvious? Even though earnings have been strong, is the future all that bright? Now to discuss all that and much more, the shape of the economy, which way things are likely to move, how exactly markets are pricing in, is it only liquidity and global cues? It gives me great pleasure to bring on board Surendra Goyal, Head of India Citi Research, and Samiran Chakraborty, Managing Director and Chief Economist with Citi India Research. Gentlemen, good to have you back on the show. Thank you for joining us. Samiran, I guess the introduction itself can be framed into a simple question, which is that in the first wave the fear was more and the magnitude was less, but we had a national lockdown. In the second wave the magnitude is more, the casualties are more, and the sentiment really has taken a big hit. So what is your assessment of the second wave on the economy? Because you are making a relative case the impact will be less. So let's discuss that.
Sure, Nikunja. Thanks for having me on the show. The way we are looking at things is that in the first quarter, where the brunt of the second wave would be felt, the impact will be less than the first wave first quarter. The reason being that the economy has started understanding how to live with the virus. And this is not just India, but globally what we are observing is that the extent to which the lockdown-related restrictions are, compared to that, the impact on economic activity is much lower. Also, we have to understand that this time around, the restrictions itself were done in a more nuanced fashion. So certain kinds of industrial activities and construction activities, etc., they were still allowed. So we can see it in our data that those segments of the economy have not been impacted as much. The open question is that how much or how fast do we get out of this mess? Is it going to be as fast as the first wave where the pent-up demand really took us up very sharply, or is it going to be slower? We have taken a call that maybe the pace of recovery is going to be a tad slower than what we had observed during the first wave. And that's not because of the damage to the income or jobs of the households, but it's more because of the sentiment factor. The RBI's consumer confidence survey is showing that the consumer confidence today is even weaker than what it was during the first wave. So that makes us a bit cautious in saying that maybe the pace of the recovery is going to be somewhat lower than what we had thought during the first wave.
Okay, Samiran, my immediate follow-up question is that there is a big naysayer club, and the naysayer club has the following opinion, which is that inflation is high, this wave has impacted savings, sentiment will remain subdued, and supply chain in a sense have got disrupted, and the rural economy this time has taken a hit. What would you argue in front of that naysayer club who is really writing an obituary in terms of an economic recovery?
Well, theoretically, all of those arguments are possible. The key question is to understand that to what extent these factors will be counteracted by the sentiment factor. This is an economy which is extremely young and a dynamic economy. Everyone has to move out, or a lot of people has to move out to earn their living. And in that kind of an economy, the moment the virus curve comes down and the moment the vaccination gathers pace, the sentiment could turn quite quickly as well. So maybe for next couple of months, things will just first come back to, let's say, about 90-95% of where we were pre the second COVID wave. But then to go above 100% of that, we would require that confidence to come back. And I think the vaccination process will be very critical in giving back that consumer confidence. In our data, we are not finding that the labor market disruption, whether jobs or income, has been as large as the first wave, which will linger on for longer. So the crude way of putting it is that the litmus test of everything will be by the time we get into the festive season. If the economy has mended enough by then, if the vaccination process has gathered pace and done a large amount of at least urban vaccination by then we can see that the demand situation somewhat normalizes by the festive season. And we have seen it globally in all countries that the moment the vaccination gathers pace, the consumer sentiment changes very substantially.
Surendra, if I take a leaf from your India strategy report, it says upgrades are welcomed, but a lot is priced in. When you say a lot is priced in, is this based on the fact that you expect earnings to slow down, or you think based on historical benchmarks, which is P and price to book, the headroom is not there?
Sure, Nikunj. Thanks for having us on the show. So I'll make 2 or 3 observations in response to that. See, firstly, while we have seen EPS upgrades, one really needs to look at the breakup of those upgrades, where those upgrades are coming from. If you look at earnings from March end till recently, while Nifty earnings have gotten upgraded low single digits, 2-3% if you look at consensus, bulk of the upgrades are coming from commodities, which tends to be more volatile than any other sector. If you take out commodities, then earnings have actually been possibly flattish to slightly down. Okay, so that's the first point I would make around the sectors which are driving earnings and the historical volatility associated with those sectors. The second point I would make is, if you look at consensus today, it's pricing in around 35% earnings growth already for FY22. Even our bottom-up expectation is around the same number, 32-33%. So there is a very strong recovery which is already being priced in. And on those numbers, the market is already trading at valuations which are close to 2 standard deviation above the 5-year mean that the market has traded at. On a relative basis, if you look at India, MSCI India, it trades at a 53-54% premium to MSCI emerging markets, which is also pretty much a 2-year high. So in that is what we meant when we are saying that the markets are pricing in a lot of positives. They are pricing in a good recovery. They are pricing in good earnings growth, and the valuations are also on the higher side. So that is how I would summarize our thought process as.
Having said that, Surendra, are you a bit surprised with the kind of liquidity which is coming to India? I mean, the case is very clear that developed markets are in a much better position in terms of growth and also on the medical front and also the visibility of earnings. But barring some odd patches, net the global liquidity this year has been rather strong and impressive.
Absolutely, Nikunj. So clearly the liquidity has been surprising and the strength has continued. If you look at last year, November, December, India had almost $16-17 billion of FII inflows in 2 months, which was pretty strong. I don't remember when we had that kind of inflows in just a two-month span. But usually what we see after that kind of inflow, you tend to hit a period where things are a little slow. But so far this year, we have already had 7 billion plus of inflows on the foreign side. And in the recent months, we have even seen that the domestic liquidity is kind of, or domestic mutual fund flow inflows are also kind of coming back, and the retail activity is also high. So when you put it all together, I think that has definitely been a support for the markets. And it has been a bit surprising, like at least for us, because I remember early in the year, we did think that we have already had very strong inflows and maybe it tapers off a bit. And as you rightly pointed out, when we saw what was happening in US, what was happening in UK, where vaccinations were proceeding, growth was coming back, it did feel like that you could have like a relatively, countries like India could be at a bit of a disadvantage, but that has not really played out. Liquidity continues to be very strong as we speak.
Samiran, for the moment, we are enjoying the benefits of inflation because commodity prices, both soft commodity and hard commodity prices have gone higher. There is an uptick which is there in real estate demand, and we've been waiting for this pricing power to come back, the healthy pricing power to come back, at least on the WPI front. But are we at that point, Samiran, where now inflation could start biting us? Because that in a sense will determine a lot for the bond market and a lot for the equity market.
So Anuj, we are in a very peculiar situation now, where the WPI CPI divergence is at a very acute phase, and it's weird that bond markets typically just track the CPI, while the equity markets they track more the WPI, and that way, we could see a divergence in the impact of inflation on the two markets. But if I just take a step back, what our understanding is that there is still some pass-through of global commodity prices to be felt on the WPI itself. We estimate that about 100 basis point increase in WPI can come just on the back of that. And we are thinking in the next couple of months, we will see probably something like a 14% WPI print. And WPI could stay as elevated as in double digits for most part of the year if our forecasts are correct. But against that, what we are seeing is that the pass-through of WPI into CPI is varied across sectors. In certain sectors, it has been almost entirely passed through. In certain sectors, it's a very incomplete pass-through. But what worries us is that the WPI food component in the last 6 months or so have started moving up, which has not yet got reflected in the CPI food number. So while we expect the average CPI to be half of WPI, something like 5.5% for FY22, the key upside risk that we'll be observing is how much of this increase in WPI food gets translated into higher CPI food going forward. It's quite clear that at this moment, the pass-through on the non-food manufactured parts of CPI is not very large. And since it's a very small component of overall CPI, the headline CPI number might not worry the central bank too much into taking action and keep the bond markets relatively well anchored.
Samiran, in your report, you are making a case for a K-shaped recovery, which you made even after the first wave. Will that K-shaped recovery get more and more pronounced now?
Yes, that's something which, as an economist, I would definitely be worried about, that you would require a significant policy intervention to ensure that it does not happen. Look, part of this K-shaped recovery, in a sense, would be welcome. What I mean is that we know that there is a process of formalization going on in the economy. And in that process of formalization, some degree of this K-shaped recovery is just par for the course. But what our analysis seems to suggest is that we are reaching a point where this K-shaped recovery might lead to some amount of inequality in the system, which could become a more longer-term structural challenge for India. So in that sense, I guess it is the fiscal policy which has to play the role of a distributive mechanism in which the benefits are more equally passed on to the lower section of the society, which have been more impacted by the virus, and ensure that the steepness of the K is not as acute as what we are witnessing today. I'm not arguing against formalization. That's definitely welcome. But I'm saying that a conscious policy attempt needs to be taken to ensure that even the bottom part of the economy is not completely left out.
Another big difference this time is the corporate balance sheets are much more stronger. They become resilient, they've adopted digital, the balance sheets are better. How does that change the dynamic? I mean, if the corporate balance sheets are stronger, can the capex cycle and the investment cycle surprise earnings? Because earnings, when they come back, they can really surprise us also.
So, Nikunj, you are right on that. Clearly, the balance sheets are much stronger. And if you kind of compare today's situation versus few years back, in some of the sectors like metals, there was a lot of stress few years back. But today, with strong pricing, those companies have deleveraged and their balance sheets are looking quite good. And which is why we did see a spate of announcements, particularly by the steel companies, post the fourth quarter results talking about capex announcements, and these kind of announcements have not come through in the past many years. So you are absolutely right on that part. Balance sheets are better, and companies, they have obviously this second wave, they managed it better, because I think there were a lot of learnings from the first wave in terms of supply chain, in terms of their own preparation, in terms of the digital, so on, right? So when that's right. Having said that, I think what will be important is the pace of recovery, because what the second COVID wave has done is it has pushed out things by 6 to 9 months in our view. So we do expect that some amount of capex recovery. I already mentioned steel as a sector. We are seeing it in some of the smaller sectors from a capex perspective, some cement, some chemicals companies starting to announce capex, right? So all of that is happening. So we do expect that to play out. But I would still think that that part of the economy is still a relatively small part of the market, of the index. And that also there is a reasonable expectation which is already priced in. So while it could definitely surprise, I think at an index level, the surprises will be moderate, because there is an expectation that things will only improve from here.
In your model portfolio, Surendra, you overweight pharma. This is a sector where valuations are stretched and it's overweight sector. So what's the surprise for pharma stocks from here now?
So Nikunj, so when you say valuations are stretched, right, if you are putting it in a historical context, I don't see too many sectors where valuations are not at the higher end of where they have traded over a 5-10 year period, right? So which is a tough situation to be in. I think the only sector where you could argue that valuations are okay in the 5-year context is possibly financials, and that too if you exclude some of the larger banks and so on, right? So in pharma, I think the opportunity always tends to be more bottom up. Like if you see some of the names in the portfolio that are there are very specific opportunities, be it on the specialty pharma side, be it on the injectable side and so on, right? So there are very specific opportunities, and that's how we have always looked at pharma. We have looked at pharma in terms of the specific opportunities and then kind of overlaid it with valuation. And then wherever we see upside, that is where we are overweight. And pharma has always been a very bottom-up sector. So while we do have a small overweight on pharma, it is based on very company-specific reasons, which is driving that overweight stance on a couple of names in pharma.
Samiran, I want to go back to the bottom of the pyramid aspect once again, which is that at the bottom of the pyramid, there are two factors at play. Rural India has got affected more and savings are likely to get dented. How do you see the bottom end of the consumption cycle changing? I mean, are we in for tough times there?
Yes, that's the risk, Nikunj, we are running. That what's happening is that in the rural area, there seems to be a disconnect between the agrarian part of rural and the non-agrarian part of rural. The agrarian part of rural is doing reasonably well, not only because the productions are hitting record highs every year, but also because after a long time, there seems to be some terms of trade improvement for agriculture. The agricultural pricing has been better, which is going to help the agricultural part of rural demand. It is a non-agricultural part of rural demand which I'm more worried about. And that's why what we are witnessing in our high-frequency rural demand indicators is that it was flatlining even before the second COVID wave. And after the second COVID wave, we see that the rural demand has declined even more than what has been the decline in urban demand. So going forward, unless we get a large amount of fiscal stimulus into the rural economy the way we had in the first wave, it seems that that aspect of rural demand could remain challenging. Whereas the urban side of demand, particularly at the bottom end, there also we could see similar challenges. We don't have as much data for that to give a very clear-cut picture on exactly how badly it has been impacted. But my fear has always been that the fiscal stimulus tend to always get towards the rural side of the economy and not so much towards the urban poor. That has traditionally what has happened. And that way, this segment could remain under pressure for longer. The odd way economists also needs to look at it is to say that the bulk of consumption, which affects the GDP number at the end, happens with the top 250, 300 million people. And we could see the exact replica of the first wave, where this 250, 300 million people are less impacted, which means the overall consumption also gets less impacted, while a humanitarian crisis is there at the bottom end of the pyramid, both at the rural level as well as the urban poor level.
Samiran, we spoke about financials, but let's recall a conversation which we had a couple of years ago, and you said, look, consumers don't surprise. That's the reason why they demand premium P multiples. But metals and corporate banks, they surprise or they disappoint. That's the reason why P multiples always vary. Metals have surprised us. Do you think corporate banks, which is an overweight position in your portfolio, could also surprise us? Is that the delta in the market now?
Yeah, sure, Nikunj. So on corporate banks, I'll make a couple of points, right? So firstly, things had been improving gradually till the second wave of COVID kind of impacted the economy again. And if you look at valuations of the corporate banks, right, and I'll mention maybe the three large names in that space, private as well as PSU, the valuations are still quite reasonable. If you take a 5-year kind of a benchmark, then valuations are trading at mean, and things should only improve from here. The other point I think one needs to keep in mind is these banks have already made provisions. Their capital ratios, etc., are all looking very good, and they are market share gainers. So as things improve, as the economy recovers, I think that is one part of the market which could do well in our view. And secondly, if we get the capex recovery cycle, maybe some point next year we start seeing that, then these are also plays on that theme. So given the risk reward where valuations are and what the outlook is, that part of the market looks quite good to us. And that is the reason we have that as one of the biggest overweights in our India model portfolio.
Gentlemen, it's been an absolute pleasure to have you both on the show and talk about a range of topics in terms of view on economy, view on sectors, why valuations are looking stretched, and where some of the key sectors are headed. Stay safe, Surendra, Samiran, and thank you for joining us on the show.
Thanks.
Thanks.